the IRS hiring thousands of new auditors this year, it's more important than ever that we as investors are properly tracking and reporting our income taxes, because failure to do so will result in penalties that will set us farther back than any of the gains that we had made. This is why I'm going to show you what I'm planning on doing with my portfolio before year end to make sure I'm in compliance with tax standards. And I'm breaking this up into 3 different sections: regular crypto trades, NFTs, and staking income. And you're going to want to make sure that you stick around to the end of the video, because I go over on how I'm lowering my staking income step by step, as well as ways you can completely avoid paying income taxes altogether that will apply to a few of you. Let's get into it. What's up, guys? My name is Chris, and on this channel, I cover all things online money with the goal of sharing with you my journey of creating as many passive income streams as possible. And with all that online money means that we have to pay taxes. And that's what I'll be covering today, specifically crypto taxes. Now, the goal with any kind of income tax is to legally get your income taxes as low as possible, going through all of the different guidelines. And since the inception of virtual currency, the IRS over the years has released more and more information. And although there are still some pockets of crypto that do have gray area, at the end of the day, any kind of taxable event is classified as income, and you need to know how to classify that when handing that information over to your CPA. But before I get into that, if you do like videos about making money online, be sure to like and subscribe. New videos coming out every single week, as well as a free Discord and Facebook group in the description below where you can network and see what I'm up to. And also, I'm not a financial advisor or CPA. I'm just relaying to you what I'm doing with my portfolio. And if you do want to talk to a professional, I highly recommend consulting LegalZoom's $30 a month legal package, where you get unlimited tax and legal advice. And this is something I've been using over the last 4 years. And although it is basic information, it can kind of point you in the right direction. So I'm going to be breaking this up into 3 parts. The first is trading and selling cryptocurrencies. Second is NFTs. And last is staking income. And all of this income will be recorded on the IRS Form 8949, which will be available for you to download in the link below. However, your CPA should be providing that to you. Now, the first part about trading cryptocurrency is pretty clearly outlined by the IRS, and there really isn't too much room for interpretation here. And the first thing we need to define is what a long-term capital gain and a short-term capital gain is. The IRS defines a long-term capital gain as anything that has been held for longer than a year and then is sold after that year. And a short-term capital gain is anything that you sell without holding a year. So it could be 11 months, it could be 1 day. And this is really important because the tax brackets for long-term and short-term capital gains are completely different, and they also get classified on your income taxes completely different. Now, as you can see on this chart right here, when it comes to long-term capital gains, anything that is less than $200,000 gets taxed at a 15% rate, and anything that's classified as $39,375 or less gets a 0% tax rate on that realized income. So let's go ahead and run through an example. Let's say you purchase 20 Ethereum at $500, and then 1 year later, you sell those 20 Ethereum for $4,000 each. That means that you have a net profit of $70,000 of realized income. And this realized income is what you're going to have to claim on your taxes. Now, before you sold, that $70,000 was unrealized income, and that does not have to be claimed on your taxes. Only when you sell, that is a taxable event. Now, as you can see on this chart right here, a short-term capital gain is taxed completely different. So let's run through an example of a short-term capital gain. So let's say you sold those 20 Ethereum at the 10-month mark. Now that $70,000 profit that you made is going to be taxed completely different. Now that $70,000 profit is going to be taxed at a 22% bracket because it's less than $84,200. However, that $70,000 short-term capital gain gets added onto your income. And this is very important to know what your income is, because that $70,000 could push your other income into completely different tax brackets. You're not only going to be getting a larger tax on your short-term capital gain, but your regular income that you made throughout the year could also be getting more taxes on it, which is extremely important to know before cashing out crypto, and you need to factor that in. And this also means that you can deduct losses as well from your long-term and short-term capital gain to lower that taxable income. And a software I use that really keeps track of this all for me is CryptoTrader.tax. And I like this because you can sync up all of your wallets, all of your exchanges, and it will quickly pull all of those transactions so you can see all of your information, and then you can give all of that information to your CPA, and it will save you so much time. Next up are NFTs, or non-fungible tokens, and we need to know the taxable events surrounding NFTs so we know when we'll get taxed. And there are 3 types of taxable events with NFTs. First is purchasing that NFT with crypto. Second is trading an NFT for another NFT. And the third is selling that NFT back into crypto. Now, this is really the first area where there's an argument on how NFT should be taxed because there's such a gray area with what the IRS has outlined. And the argument in summary is, should it be taxed as a collectible similar to like high-end artwork that's taxed at a 28% tax bracket, or should it be taxed at those previous short-term and long-term capital gains that I previously mentioned? And in my unprofessional opinion, I think it should be the latter, because as NFTs have grown in utility, they're not just artwork anymore. I personally do not own one NFT that is classified as artwork. Everything that I own has some utility behind it. So let's go ahead and run through an example where we pay that 28% tax on that NFT. So let's say we purchased an NFT for $1,000 and 5 months later, we sell that for $10,000. That means that we get taxed 28% on that $9,000 profit that was incurred, which comes out to be $2,520. One thing that I do want to mention is, do not forget to keep track of the fees that are associated with purchasing your NFT, especially the ones on OpenSea and Ethereum blockchain. There will be fees there. And I personally have not uploaded any of my NFTs that I have inside of Crypto Trader Tax. However, I do imagine that there probably is a software out there that does that for you. I just keep track of mine on Google Drive because I just only have a handful of NFTs. Now, what about NFTs that are considered blue chip or NFTs that are land parcels? And I've already talked with my accountant, and I plan on counting my land parcel as an asset on my books. Now, there's also a third section of NFTs that has gray area around it, which is when you stake that NFT and you earn tokens. What happens with the tokens that you earn? Which leads me into the third part of the series, which is staking income, and how do we classify that according to the IRS. Now, when it comes to staking, I think it's first best to understand what is considered a taxable event. So before, in the analogy, the crypto could go up or it could go down, but it's not a taxable event until you sell. It's just unrealized or realized gains. Now, this is not the case with crypto staking, whether it's an NFT or a project like Time Wonderland, or you're staking any other project. Now, when it comes to staking, anytime you earn more of that token, that is considered a taxable event. Now, in the case of projects like the DAOs, where it's compounding 3 times per day, that means that there are 3 taxable events that are happening per day. However, there is a way to mitigate these taxable events on your staking income, and that's by wrapping your tokens. And the YouTube channel Price Time did an excellent job of explaining this, but when you wrap your tokens, it's like putting them inside of a vault where the tokens can go up in value, but because they're wrapped, it's considered an unrealized gain. And it's not considered another taxable event until you unwrap them. Now, a way you can quickly see if the project that you're staking does offer wrapping is you can just go inside of CoinMarketCap, just type in wrapped and then followed by your cryptocurrency name, and you can see if it populates or not. And this works most of the time. However, I'll give you an example of a project that I'm currently staking that does not work for this example, and that is HectorDAO. So if you go to HectorDAO's website, they actually have wrapping available on the website. But if you're still not sure after going to your project's website, I think the best method would just be to go to the community Discord and just ask the founders there, and they should be able to point you in the right direction. Another example that I've talked about on the channel is Wonderland Time, where you go to the site abracadabra.money and you can wrap your memo that you're staking there. Now, all this being said, wrapping does not really save you on taxes, because if you unwrap before a year's up, you still get taxed at that short-term capital gain, which would be the same across the board. However, the reason why I'm still wrapping my tokens is because when I have them wrapped, that means that the income that I'm making on that staked income, I do not have to claim this year. And I could unwrap on January 2nd, which would push that income into the next tax year, which is something I might do. Now, as I said, I was going to mention a couple of ways where you can completely avoid crypto taxes altogether legally. And the first way is finding a state that has low capital gains taxes. And a really popular safe haven for crypto millionaires is Puerto Rico. And the reason why people move to Puerto Rico is because if they made $1 million in crypto, let's say they invested $1,000 into Shiba Inu and now they have 1.5 million. If they cash that out right now, they could potentially have to pay 35% or over $350,000 on that investment. So by them moving to Puerto Rico, that could mean essentially a free house and a bunch of other amenities. And there are some strict stipulations when it comes to this and rules that you have to go by, but I'm not really going to get too much into that because honestly, I don't think it really applies to too many of us. And the last method I'm going to mention, and this was actually brought to my attention by someone in my Discord, which is setting up a charitable remain trust. And it's a legal way to avoid taxes paying crypto. Now, you do need an attorney to set this up, and it costs anywhere from $3,000 to $8,000, and it will last for 20 years. So once you have your attorney set that up and then you set up an annuity, that charity then can pay you out 7% of your crypto income. Now, although you are taxed on the 7% of income that you do receive from that charity, you can write off of 30% of the entire portfolio value over the course of 5 years, which means that you can write off 6% of that profit, which means that you're only paying 1% a year on 7% of your entire portfolio. And for me, that just doesn't make sense. I mean, maybe if I made over $1 million with crypto, I might think about it. That would be $70,000 a year. That's a nice salary, and not paying any taxes on that, that would be really cool. But that's not really something I'm looking into right now. But one thing I really do want to stress is finding a CPA, not only one that's good that you can trust, but also knowledgeable with crypto. A lot of people just ask their friends and family, and I think that's a great place to start. And guys, if you do like videos about making money online, be sure to like and subscribe. My next video coming out, I'll be covering 3 different metaverse coins that I see that have a chance to explode in 2022. And as always, guys, thanks for watching, and I'll see you next time.